My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Banking and Insurance, third unit. Important short and long questions and answers. Let's start quick revision. First important short question is Economic Model. Banks operate using an economic model that revolves around the concept of intermediation connecting depositors who provide funds and borrowers who use those funds. They charge interest on loans and pay interest on deposits, earning a profit from the difference, the spread. For example, a bank may lend money to a small business at 8% interest while paying its depositors 2%. This spread is the bank's primary source of income. The model also includes managing risks like credit, liquidity, and interest rate fluctuations to ensure profitability and stability. Next important short question is Regulatory Capital. Regulatory capital refers to the minimum amount of capital that banks must hold to absorb potential losses and reduce the risk of insolvency. This capital is regulated by financial authorities to ensure banks remain solvent and protect depositors. It typically includes Tier 1 core capital and Tier 2 supplementary capital. For example, under Basel III regulations, a bank must maintain a minimum Tier 1 capital ratio of 6%, meaning it must have enough capital to cover 6% of its risk-weighted assets. This ensures the bank can absorb shocks while maintaining financial stability. Next important short question is Write about banking innovations. Banking innovations refer to the development and implementation of new technologies, products, and services to improve banking efficiency and customer experience. One notable example is mobile banking, which allows users to access their bank accounts and perform transactions via smartphones, enhancing convenience. Another example is blockchain technology, which provides secure, transparent transactions, often used in cryptocurrency and cross-border payments. AI-powered chatbots are also revolutionizing customer service, providing instant assistance. These innovations have made banking more accessible, faster, and secure, transforming how consumers and businesses interact with financial institutions. Next important short question is National Electronic Funds Transfer. National Electronic Funds Transfer, NEFT, is an electronic payment system that enables the transfer of funds between banks within a country. It operates on a Deferred Net Settlement (DNS) basis, meaning transactions are settled in batches at specific intervals. For example, a customer of Bank A can transfer money to a customer of Bank B through NEFT by providing details like the recipient's account number and IFSC code. NEFT is widely used for domestic payments like bill payments, salary transfers, and online purchases, offering a secure and efficient alternative to traditional paper-based transactions. Next important short question is Bancassurance. Bancassurance refers to the partnership between a bank and an insurance company to sell insurance products through the bank's distribution channels. This allows banks to offer a range of insurance products like life, health, and general insurance to their customers. For example, a bank may offer a life insurance policy to its account holders, with premiums paid through automatic deductions from their bank accounts. Bancassurance benefits both parties. Banks expand their services and revenue, while insurance companies gain access to a large customer base, providing convenience to customers seeking financial and insurance solutions in one place. Next important short question is clearing and gateways. Clearing and gateways are essential components in financial transactions. Clearing refers to the process of reconciling and validating payment instructions between banks before settlement. For example, after a customer writes a check, the clearing process ensures that the funds are available in their account before transferring them to the recipient's bank. Gateways, on the other hand, are technology platforms that facilitate the secure transmission of payment information between parties. For example, an online payment gateway like PayPal processes payment details from the customer to the merchant, ensuring secure and smooth transactions in e-commerce. First important long question is: explain the significance and applicability of Basel Accords in banking system. The Basel Accords are a set of international banking regulations developed by the Basel Committee on Banking Supervision, BCBS, to promote financial stability, ensure adequate capital requirements, and minimize the risk of banking crisis. These accords provide a standardized framework for banks to follow, helping to safeguard the global financial system. The Basel Accords include Basel I, Basel II, and Basel III, each progressively enhancing regulatory requirements. 1. Basel I, 1988. The first Basel Accord primarily focused on the capital adequacy of banks. It established minimum capital requirements, 8% of risk-weighted assets, to ensure banks had enough capital to absorb losses. For example, if a bank lent money to a corporation, it had to hold capital proportional to the risk of the loan. This helped maintain stability, especially after major financial crises. 2. Basel II, 2004. Basel II refined the capital requirements by introducing more risk-sensitive measures. It required banks to calculate capital adequacy based on 3 pillars. Pillar 1. Minimum capital requirements based on credit, market, and operational risks. Pillar 2. Supervisory review of a bank's internal processes for managing risk. Pillar 3. Market discipline through greater transparency and disclosure. For example, if a bank had significant exposure to mortgage-backed securities, Basel II required it to hold more capital to cover potential losses from the housing market collapse. 3. Basel III, 2010. In response to the 2007 to 2008 global financial crisis, Basel III introduced stricter capital and liquidity requirements to enhance the banking system's resilience. Key measures include: Tier 1 capital ratio increased to 6% from 4% under Basel II. Leverage ratio, a limit to prevent excessive borrowing. Liquidity coverage ratio, LCR, ensures banks have enough liquid assets to withstand short-term financial stress. For instance, banks must hold higher quality capital, such as common equity, to withstand economic downturns and avoid a repeat of the financial crisis. The Basel Accords are globally applicable, with banks across different jurisdictions required to implement these regulations. The Accords strengthen the banking sector's resilience, help maintain confidence in the financial system, and protect depositors, as seen with the enhanced stability of banks during recent crises. In conclusion, the Basel Accords are critical for managing risk in the banking system, ensuring banks operate with sufficient capital and liquidity to protect against financial shocks. Next important long question is: discuss the issues in core banking solution and suggest some measures for its effective functioning. Core banking solutions, CBAs, are critical for modern banks as they centralize and streamline banking operations, allowing for better customer service and efficient management of resources. However, there are several issues associated with the implementation and functioning of CBAs, which can hinder its effectiveness. Issues in core banking solutions. 1. Data security. Since CBAs involves the storage and transfer of sensitive customer information, there is a risk of cyber attacks, fraud, and data breaches. For instance, a hack on a CBA's system could lead to massive financial losses and a loss of customer trust. 2. System downtime. CBA's systems are complex, and occasional technical failures or maintenance issues can lead to system downtimes, interrupting banking services. For example, if the CBAs goes down during peak transaction hours, customers may be unable to access their accounts or process payments. 3. High implementation costs. The cost of setting up and maintaining a CBAs can be significant, especially for smaller banks. This includes both financial and human resource investments in training staff and ensuring proper integration across branches and departments. 4. Integration with legacy systems. Banks often have existing legacy systems that may not seamlessly integrate with new CBAs platforms. This can cause inefficiencies, data inconsistency, and delays in transactions, impacting customer experience. 5. Scalability issues. As banks grow, their CBAs must be scalable to handle increased transaction volumes and new financial products. Some systems might struggle with scaling efficiently, leading to performance bottlenecks. Measures for effective functioning. 1. Enhanced security protocols. Banks should invest in robust encryption, multi-factor authentication, and regular security audits to prevent breaches and protect customer data. For example, implementing end-to-end encryption for transactions can significantly reduce the risk of cyber attacks. 2. Regular system maintenance and upgrades to minimize downtimes. Banks should schedule regular system maintenance and invest in high availability infrastructure that allows for continuous banking operations. For instance, having a backup system can ensure minimal disruption during technical failures. 3. Comprehensive staff training, ensuring that all staff are adequately trained in CBA's functionalities helps avoid operational errors. Regular workshops and training sessions can keep employees up to date on new features and troubleshooting procedures. 4. Cloud-based solutions. Adopting cloud-based CBAs can provide better scalability, cost-effectiveness, and integration with various banking functions. Cloud solutions allow for faster updates and easy scalability to handle growing volumes of transactions. 5. Integration with existing systems. A phased approach to integrate CBAs with legacy systems can help ensure smooth transitions and avoid disruptions. A proper interface or middleware can be used to sync old and new systems, ensuring data consistency. In conclusion, while CBAs offers numerous advantages in modern banking addressing issues such as security, system downtimes, and integration. Challenges is crucial for its efficient functioning. Implementing strategic measures like regular updates, robust security, and staff training can significantly enhance its effectiveness. Next important long question is: explain the major retail banking products and services. Retail banking refers to the services banks provide to individual consumers, rather than businesses or institutions. It includes a range of products designed to manage personal finances, facilitate transactions, and offer credit. The major retail banking products and services include: 1. Savings accounts. These are basic deposit accounts where customers can store money and earn interest. Banks typically offer different types of savings accounts with varying interest rates. For example, a customer may open a savings account with an interest rate of 2% per annum. 2. Current accounts. These accounts are designed for everyday transactions such as receiving wages or paying bills. They usually do not offer interest but provide easy access to funds through checks, debit cards, and online banking. An example is a student checking account that offers no fees and minimal balance requirements. 3. Credit cards. These allow customers to borrow funds up to a preset limit to make purchases or withdraw cash. Banks charge interest on outstanding balances. For instance, a customer might use a credit card for online shopping and pay back the balance over several months, incurring interest if not paid in full. 4. Loans and mortgages. Retail banks provide personal loans for various purposes, example, car purchase, home renovation, and mortgages for purchasing homes. A customer might take out a mortgage with a 3% interest rate to buy a house, paying it off over 20 years. 5. Auto loans. These are loans specifically designed to help customers purchase vehicles. An example would be a customer securing a 5-year auto loan at a 6% interest rate to finance a new car. 6. Insurance products. Retail banks often offer life, health, or auto insurance to their customers, often through partnerships with insurance companies. For example, a bank might provide health insurance as part of a bundled offering with a mortgage. 7. Investment services. Banks may also offer investment products like mutual funds, stocks, or retirement plans, allowing individuals to grow their wealth. A typical service is a retirement savings plan like a 401k. Through these products, retail banking serves as an essential part of individuals' daily financial needs, enabling them to save, invest, spend, and borrow efficiently. Next important long question is: describe the payment and settlement systems in banks. Payment and settlement systems in banks are the mechanisms that facilitate the transfer of funds between individuals, businesses, and financial institutions. These systems ensure that payments are made and settled accurately and securely. Here are the key components of payment and settlement systems. 1. Payment systems. These systems allow for the transfer of funds between bank accounts to settle obligations. Common payment methods include wire transfers. These involve transferring funds electronically between banks. For example, a customer can initiate a wire transfer to pay for an international invoice. Debit and credit cards. These cards are linked to bank accounts or credit lines, enabling customers to make purchases. For instance, using a credit card to buy goods online involves the bank settling the payment with the merchant. ARC, Automated Clearing House. This system processes batches of transactions such as direct deposits, bill payments, or payroll. For example, an employer may use ARC to deposit salaries directly into employees' accounts. Real-time payments (RTP). Some systems, such as the US RTE network, allow for instant transfers. For instance, a person can use an app to send money instantly to a friend, with both accounts updated in real time. 2. Settlement systems. After payments are initiated, the settlement system ensures that funds are transferred between the involved parties and their respective banks. This involves centralized settlement. This system ensures that transactions are settled at a central clearing house or the central bank. A common example is the Federal Reserve's FedWire system, which settles high-value payments in the US. Netting. In some cases, payments are not settled individually but in batches. For example, banks may net out their obligations with each other, subtracting payments owed from payments received before transferring the final settlement amount. 3. Clearing. The process where the details of a transaction are verified before the settlement occurs. For example, before a check is cleared, the bank checks whether sufficient funds are available. These systems help ensure that money transfers are accurate, secure, and efficient. For example, when you send a payment using an app like PayPal, the payment is processed and settled through the ARC or RTP system, ensuring the money reaches the recipient's bank securely. The entire payment and settlement process plays a critical role in the functioning of modern economies. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.